Today, we're going to talk about venture capital. And I know that it's not a new topic, and you've read everything you needed to read about venture capital. You met enough venture capitalists in your life, and you know what you like and don't like about them. So what we'll do, we'll talk about something which people usually do not talk. As long as that table over there gets quiet, we'll tell you what we'll talk about. Okay. So, how many of you are entrepreneurs? Right? How many of you are investors? How many of you are professional investors, that is venture capitalists? Okay, wonderful. Some of you raise your hands both when I called entrepreneurs and investors, which is good. Because a lot of funds start these days just the way any startup will. So what we'll do, I ask our panelists, Eric Boutoir, Drew Clark, Skip Fleshman, and Bill Larcher to introduce themselves and their companies the way they want to. So instead of my telling you what I think their fund is doing and why these people are great, I would like each one of you to take 2-3 minutes and introduce your fund and yourself and what your specialty in your fund is. We'll start with Bill.
Excellent. Good afternoon. First of all, I want to say thank you for letting me be a part of this, and thank you, Sasha. Delighted to be here this afternoon. My name is Bill Reichert, and I'm Managing Director at Garage Technology Ventures. Garage is a seed stage and early stage venture capital fund here in Palo Alto. I have two other partners in addition to myself. Joyce Chung and Guy Kawasaki are the two other partners at Garage. We started Garage in 1998 after each of us came from varied entrepreneurial backgrounds. I spent most of my career as an entrepreneur, mainly in software. I started my first software company at Stanford while I was a graduate student. I like to say before it was fashionable to drop out of school and start companies. I actually graduated and started a company, and then did 4 other venture-backed startups, mainly in the software space, broadly defined, before we started Garage. The big idea behind Garage is we wanted to be the entrepreneur's venture firm, the place where entrepreneurs could go to start up their startups. And so that's how we started in 1998. We actually started Garage as an accelerator and then raised a fund and became a more pure play venture capital fund. Our thesis is that brilliant technology and brilliant teams don't only come from Silicon Valley, so we like to cast the net broadly to find great technologies and great teams wherever they are. We hope we can find a structure to lure at least part of the team here to Silicon Valley. But we're happy to have development teams anywhere in the world, whether it's in, Moscow or Israel or China or India or wherever. But help the companies build up their companies here in the United States with a global perspective. So that's the broad Garage focus. Our sector focuses, we like to say we're technology agnostic. We are interested in great technologies broadly defined, whether it's IT, communications, material science, clean tech. We don't do life science, though, because of the time factor and cost factor involved in life science. But other than that, we are interested in a wide array of technologies. So that's Garage. Thank you.
So I'm Skip Fleshman. I work at Asset Management Company. It's an early stage venture firm that was started in 1965, so we're beginning our 47th year. Our focus is early stage, as I said. We like seed or Series A type investments for our first typical institutional round. And it's in a wide variety of, wide spectrum of different investment companies. So we like technology and also healthcare, so we invest in both sides there. We typically like to see a good technology component to be utilized as a barrier to entry or competitive advantage. It's just one of the things we like. And of course, the traditional stuff, huge markets and a lot of adoption. As of late, we've also been somewhat interested in the application of technology into healthcare markets as well. So we call that health sciences technology. We think that's an interesting sector, which with the adoption of the iPad and iPhone and applications, we're starting to see a lot of interesting applications in that overall area. So I would say mobile, cloud computing, traditional healthcare to include some therapeutics, but also HST is an area of interest. We do focus on Silicon Valley. We think you need to be a little bit close to your investments. So most of ours originate here, although as Bill said, we encourage development in other areas. We think that's a very good leverage point. Historically, I don't have a lot of knowledge about Russian venture capital, although our founding partner, Pitch Johnson, has invested in several venture funds around the world, including Czech Republic, Poland, Bulgaria, Romania, and also one that was headquartered in Moscow and St. Petersburg. So I've probably been there 10 times in conjunction with that fund and some other events. So I just have enough knowledge to be dangerous about Russia. So.
No, I told you it will not be about Russia. It will be about venture capital, which is global. Entrepreneurs are global.
Right. But just to put things in perspective, I have a little bit of knowledge, not a lot. I think that's about it for our firm. I've been there 10 years. My background was in technology as well, so I was an engineer for the most part, and also an entrepreneur.
You guys are so polite. It's wonderful.
Hi, my name is Andrew Clark, and I'm a partner and director of strategy at IBM's Venture Capital Group. Right off the bat, I'll have to tell you that the name is somewhat misleading. We do not have a venture fund per se, but we do invest in what's called like-kind kinds of investments in startup companies. So we're looking to partner with the best entrepreneurs anywhere in the world to help provide differentiation and value to our products and brands and services that IBM sells on a worldwide basis. So we have a lot of very smart people that work for IBM, but unfortunately, not everybody is working for IBM who has a new idea or has something that's good. So we really put our group together about 11 years ago to try to reach out and connect with a lot of you in this room and elsewhere in the world to try to provide kind of a place to come with fresh ideas, with good value, and a way to kind of using IBM's strengths in markets and customers and deep technology to really bring it into practice. And so, like I said, we started this in 2000, so this is our 11th year, and we've been working with Sasha and with geographies all over the world. We're based here in Silicon Valley, up in San Mateo, but yet we have a global presence, and we have my counterparts throughout the world. We don't have one in Russia yet, but could be coming. But certainly, we're present there every year. We're in Brazil, we're in India, we're in China. We are wherever smart entrepreneurs are. And so we essentially, my team helps connect the dots between great new companies and IBM. So we are essentially the on-ramp, if you will. We focus across a broad range of IT. Just about everything to do with IT is in our scope. Some of the more interesting areas you might not be aware of are areas like clean tech. So we're not in the energy industry, but yet we have a perspective, a point of view that our customers value around areas like alternative energy and energy efficiency and new kinds of materials, transportation, those kinds of things. And so we look for companies that can help provide us with a partner who can add value to traditional IT software and services. And together we can take that to the market. We can take that to, say, large utility companies or energy operators, people like that. And so we cover traditional industries, healthcare, government, education, clean tech, traditional industries that you might think about. But it's always kind of where the industry meets IT. That's kind of the sweet spot for IBM. So we're looking for some great new companies that can help us fill in those gaps and can help us produce superior solutions to address customers there. As we go through, I'll talk more about specific areas. Thank you.
Sorry, my name is Eric Buatois. I'm a managing partner at a firm called Sofinova Ventures. The firm has been in the early stage venture capital business since the early 70s, investing both in technology and life science, mainly drug development. The firm has been doing cross-border investments since almost 40 years, starting initially between Silicon Valley and Europe, expanding over time with Israel and India. And since a couple of years, we are doing more and more activities in Russia. We have about $1 billion under management. We closed a new life science fund a couple of months ago for $440 million, mainly for drug development. On the technology side, we focus on very technology-intensive companies with a center around the mobility and the wireless ecosystem. We do semiconductor material, communication system. Yes, you can make money with service provider, analytics, business intelligence in general. And since several years, we've been noticing through our portfolio that several companies have been expanding to Central Europe and Russia. I had investment that had some big software entities in Czech Republic, in Prague, in Romania, and also in Russia. Early this year, we closed a very big financing with Rusnano for a company called Crocus Technology. And that was a pretty sophisticated deal where not only we set up, we expanded our R&D operation around magnetic material for memory in Russia, but also set up a post-processing fab. And we have currently 4 of our companies in advanced conversation with the Skolkovo Foundation. So we try, our view is that there is a new corridor between Silicon Valley and Russia and Central Europe, a little bit like it was with India and China in the early 2000s, and our firm is quite interested to exploit this opportunity. Yeah.
Thank you. So, there are so many sites now where entrepreneurs rate the investors, and they get to express their opinion about venture capitalists who listen to their pitches and then decide not to invest and never explain to them why. And the question to you is, what inspired you to become an investor? When did you decide that you want to go? First of all, have you been entrepreneurs? I know that Bill said in your opening remarks you started a company. I know that Eric been with the big companies, but somewhere there's a startup somewhere, right?
Yeah.
I know for sure that Skip had a company at some point as an entrepreneur. Drew, I don't know about you. Have you had a company before?
Pretty much IBM.
Yeah. Well, it's a nice startup, but you haven't started it, right? But so the question is, when did you decide to become an investor, and what inspired you to become one? In any particular order?
Well, I'm happy to continue the order. My answer is, I guess, fairly simple in the sense that I'm kind of an accidental venture capitalist. When we started Garage, I saw it as an entrepreneurial effort. It was much more about creating a new approach to helping startups start up and to helping finance early stage high technology companies. So I saw it as an entrepreneurial opportunity rather than as an inspiration to become an investor. And with the evolution of the venture market, we became more and more traditional venture capitalists out of an entrepreneurial opportunity and requirement to become so. But the larger aspect of it, and in terms of our side, we play on the seed side. We don't see ourselves as managing money. We see ourselves as working with entrepreneurs. So in that sense, it's just an extension of our natural inclinations as entrepreneurs to want to continue to work in the entrepreneurial space.
So you're saying you never became that, that kind of investor who sits across the table, just listens to pitches and cannot relate. So you were an entrepreneur, you are an entrepreneur at heart.
I guarantee you, if you're pitching to me, you will never see me reading my email on my iPhone underneath the table.
How about your BlackBerry?
you know, you got to appreciate knowing that my partner is Guy Kawasaki. We would never own Blackberries at Garage.
I know, it was a trick question. Yeah, Skip, you want to continue?
Sure. My story really probably isn't that interesting. I was at Stanford Business School and graduated in 2001, which other than right now in venture capital was probably the first biggest nuclear winter. No one was being hired in venture capital or private equity. It was right after the bubble burst, first internet bubble burst. So I didn't really think it was much of a possibility, and I was just evaluating a bunch of different job opportunities, and a guy a year behind me introduced me to Pitch Johnson, who happened to be in aviation, which was my background, and happened to be looking for an associate, and just almost serendipitously, I ended up falling into that job, and it seemed like a pretty cool one. You could sit there, you know, not do anything, as the way Pitch says, it's a pretty cool job to sit around doing nothing.
Did she really say that? It is?
It's a great way to make money without actually doing anything. That's his exact quote. It turns out that's not completely true. I mean, there's a lot you got to do. But I thought to Bill's point, of the component of helping build businesses would be pretty intriguing, and also learning about new technologies. At the end of the day, what's most stimulating is dealing with a lot of people who are really smart. We have, you know, every day we have entrepreneurs come in from all over the world who have gone to MIT, Caltech, Stanford, Berkeley, just very smart people that are passionate, have huge visions, and they're exciting to deal with, and it's a lot of fun. So,
Drew, we established you have not been inside a startup, but you are an engineer, you were an engineer. How did you become an investor?
First, before I get into that, I want to just echo that last comment, that is the most exciting part of the job, is every day you wake up thinking, what am I going to learn today from some excited, motivated new entrepreneur? You know, what new frontiers are we going to tackle here? So that's the exciting part of the job. Yeah, we kind of started this, the venture group at IBM, with the idea that this was back in 2000, where things were kind of a bit out of control, with a lot of money going into startups, and just a lot of frothiness in the air. And the idea was that IBM had a presence in Silicon Valley, but it really wasn't leveraging all of the great talent that was there and all of the entrepreneurial spirit. And the idea was, let's build a team that can provide this connectivity between the world of entrepreneurs and startups and IBM, and let's help each other. So let's bring IBM assets to bear on helping startups reach the market, helping them get traction with customers, helping them create a distribution network that would be something that they probably couldn't achieve on their own. At the same time, IBM can benefit because we're getting some great new technologies, some enthusiastic entrepreneurs working with us, helping us stay ahead of our competitors and helping us realize new things that we couldn't do by ourselves. So we saw it as a nice win-win kind of proposition. And you know, to this day, you know, we are working with probably at any given time, maybe 2 or 3 dozen companies that are providing us with great insights into new fields. And at the same time, I think we're helping them become successful also. So it's the helping each other become successful that really gets us excited.
And Eric, and you a combination. You work with a big company and a small company. Can you think of that moment when you said that you're ready to be an investor?
Yeah, very interesting question. In fact, I had a corporate background, and I was lucky enough to have always been starting new business or new product line in pretty large company. And so basically, I was this kind of a troublemaker, always doing something on the side, always asking for money, always asking for resources, you know. And I became pretty good at that, having done it at Texas Instruments, HP, and Ericsson. And then I never thought I was an entrepreneur, in fact. And one day, I got a call from one of the partners of Sofinova, and he tells me, you know, Eric, have you considered to become a venture capitalist? I said, could you tell me what this job is about, to show you how naive I was? You know?
Which year was it?
2001. And basically, when this person explained to me the job, I discovered this is really what I like to do, which is really to find the matching between good technology and market. That's really what I love to do, find the right market for the right technology or vice versa. And also when you work in big company, you obviously you have a lot of resources, you don't have to raise money, but at the same time you have to deal with a certain hierarchy and structure. And I was feeling constrained in my field of operation, and I moved to venture capital because of that. I wanted to touch a lot of different subjects. I wanted to obviously create new businesses. And frankly, it's a very, very fulfilling job. Now it's a very difficult job because 3 days in the job, you understand it's very easy to make a check, but it's very difficult to get the money back. That's a thing you learn very fast, how difficult it is to get the money back. And that's also a job where you have to be very humble. I think every day is another day. Your big failure are just following your big success and vice versa. So it forces you to be humble and to adapt on a continuous basis. Not only adapt to the market condition, but also to the style of entrepreneur. Every board you're sitting on is a different culture, is a different atmosphere. You deal differently with different entrepreneurs. So constantly you have to adapt yourself, which is also very enriching.
You know what's interesting? Entrepreneurs think that there is not enough money. We as investors think there are not enough good companies because money is available. So if you were to summarize, when an entrepreneur comes to pitch you a company, what is it that you are looking for in that particular company that makes you to jump to that conclusion, we must write that check? So what are you looking for in a company? Because we have mostly entrepreneurs here, and I told them they're all family and friends, so you can share your secrets, right? I know you'll say you need a market, right? I know what I'll say, but let's seriously, what is it that we're looking for in a company? Skip, want to start?
I think that the answer to that in large part depends on the person, because everybody has different interests, sector interests over time. Like right now, I'm really interested in tech applied to healthcare markets. I think it's a fascinating sector. But to back up a little bit and answer Sasha's question, I think the thing that really drives you to want to write a check right off the bat is just an incredibly passionate, visionary, driven, motivated CEO or founder. I mean, that just comes out in the presentation, that someone that just wants to change the world and they're not going to let anything get in their way.
Yeah, in no particular order. You guys jump in. Yeah.
Go ahead.
Drew?
Yeah.
Yeah, well, I mean, my situation is a little different. I mean,
Well, we know. You
I'm
are
looking for
different.
some
What
of those
is
same
that?
traits, but in my case, we're looking for fit with IBM and with one of IBM's businesses. So we're looking at it from a point of view of not just relevant, are you doing something that's relevant to what we're doing, but for fit. In other words, is your business model or your approach to this topic congruent with what we're doing? Is there some synergy there? Can we envision partnering with your company? We're not necessarily looking to acquire it, but we're looking for a partnership. So we're looking at can you scale, and maybe scale is the word here. Can you scale up to keep up with an opportunity with IBM? And I'm talking about very large enterprise customers who can be very demanding even for us. And so we would be then relying on you to provide whatever your technology or service is in partnership with us, and then being able to keep up with our customers. So we're talking about being able to scale quickly and being able to scale in a way that can integrate with IBM pieces, because the whole point of it is for your piece to add value to ours and for us to be able to add value to what you're doing. And so things have to connect. And I'm not just talking architecturally, I'm mainly talking from a business model, business design sense.
Right. So it's a view from a corporate venture capital perspective. And going back to, Eric, do you want to say?
I think in our firm we are extremely people-centric. So by definition, we'll be extremely sensitive to the quality of the management team, not necessarily the experience, but the vision, the passion. Also, what we're looking a lot is the flexibility, because very often, if you look all the big success, even in the Valley, they never been built on the first business plan, and that's the same for all our successful company. there have been a couple of iterations until you hit the right target and the company really takes off. So we're looking with this kind of vision of the world, strategy, passion, but at the same time the flexibility to adapt, which is very rare because by definition these two qualities are a bit at odds. So by definition, these qualities are really combined in a very few individuals on the, I think, on the planet. Of course, a secondary item is always the market. You know, we all learn this around this table. If you play in a too small market, it's tough. So by definition, you have to play in large market, not necessarily existing market, or because you create a new technology, a new business model, you change the ecosystem, and then the markets become bigger. That's the second things we are looking at. And because we are technology investor, we always look at the level of intellectual property. Not to say that it's a silver bullet, but you know, startups always make a lot of mistakes. And what we've learned is if you have a strong IP, it creates a de facto barrier to entry. And because of that, you can iterate a couple of times before being offline. So that's what is also very interesting by IP.
So
Yeah.
Sasha, you said you wanted us to let the group in on the inside secrets of venture capital. So
Yes, that's exactly
Okay,
it. Because,
so-
you know, market, business plan, they
Right.
know all that. Yeah.
so here's the dirty little secret about venture capital. I mean,
Write
so-
it down.
So, you know, this always comes up in panels, right? And so VCs, we got to sit up here and we have to sound logical and rational and, you know, as though being, you know, just in case one of our LPs is in the audience, we want to sound like we know what we're doing, right? But here's the reality. The reality is that VCs invest in companies they fall in love with. It is actually, it's a very emotional thing. That, you know, as rational as we might be, and I won't necessarily speak for these guys, but I'll tell you, I've seen a lot of deals, I've seen a lot of investments. It's very clear we invest emotionally. We meet a team, we see a technology, we see an opportunity, and we fall in love. Now, the problem for you guys is that different VCs fall in love with different things, and you sort of heard a little bit of that, right? Most VCs say they fall in love with teams, and generally that's true, but some VCs, they fall in love with technologies. You know, there are a lot of VCs out there, they're like you guys engineers, and they fall in love with an incredibly cool something. And some VCs fall in love with opportunities to change the world. You know, we fell in love with a company called Delight Design. Delight Design has a solar rechargeable lantern designed to replace kerosene lanterns around the globe. We fell in love with the vision of the company. The team was unproven, great guys, wonderful guys, but we fell in love with the idea of this company. So VCs, they fall in love with something, and then they go back to their partners, and then they try to rationalize why they fell in love. And so due diligence is all about rationalizing why you fall in love. And, you know, and partners are supposed to keep their partners from falling in love with the wrong type. Right?
It's like mom and dad.
Right.
No, yeah.
So, but you know, sometimes the whole partnership falls in love, and that's great, and then they rationalize why they fall in love. So the challenge for you guys is don't so much focus on a checklist, right? You know, passion can be faked. You can get up there and be passionate, but that can be faked, right? You've got to figure out how to make yourselves lovable to each different VC you pitch. And that's kind of a tough challenge, but it's different. It's different than filling out a checklist.
What about valuation? See, they're falling in love with you. See what happens. What about valuation? Should the companies even bring it up at the first meeting? They're trying to be passionate and be motivated, and it's kind of confusing when people want them to know, right? But would you expect the company on the first pitch to know the evaluation?
You should know where the zone is going to be, but you shouldn't bring it up. You shouldn't bring it up. It's likely, it's possible, the investor's going to bring it up because they want to find out if you're crazy. So you should have a thoughtful response to the investor question, you know, where do you think your valuation is? And you guys talk about how you would expect someone to respond to that question.
No, for me, I think it's fundamentally a sales process. When you come, it's a first meeting, and your objective is to have a second meeting. And when you have a second meeting, the objective is to have the third meeting. So it depends totally what's happening. You could be in the first meeting, things are going so well, so you put the valuation. It could be some cases you have to wait for the fourth meeting. Now, the piece of advice I want to give evaluation, I know it's very important for the entrepreneur and also for the VC, by the way. But when you step back and you look at what you've done in the last 5, 6 years, you discover that sometimes the entry point of the valuation, even if it's very discussed and argued, is not the most important things. I consider it's a journey, and valuation is the starting point. At the end of the day, is either a company successful and you make money or not. And frankly, if it's a couple of $1 million or less or more in valuation or 10, it doesn't change fundamentally the equation. So I'm like everybody, very focused on valuation, but when I step back, I always discover that's not the most important element. I know for you it's very sensitive because it's about dilution, it's about losing part of your company, but try to think it as a journey and see where is the end point. And it makes you see the valuation in a different angle.
Because we have some Russian investors in the audience, I know a couple of people raised their hands. Is the Russian venture capitalist still here? Oh, okay. Well, anyway, then I won't ask that question. Then local versus global. I know that asset management is pretty much investing locally. I know Garage has seen all kinds of entrepreneurs, but they're mostly local companies. IBM does global stuff, but it's the nature of the corporation. Sofinova looks at all kinds of entrepreneurs. Let's talk about the foreign entrepreneur pitching in California. So you probably saw companies from Europe and Asia and Australia pitching here locally. Is there a difference in the way they present their companies? And if you were to compare, say, a startup raised and grown everything in Silicon Valley versus a startup which came to pitch from Paris or some other place. Any comments?
Okay. Yeah, it's. Oh,
go ahead. Yeah, go ahead.
Okay. So, yeah, it's the nature of Silicon Valley now and venture capital now that every team that comes into our office has a global background. I mean, it's extremely rare that a team will walk into our office made up of, a bunch of white guys who grew up in Silicon Valley, right? I mean, that's relatively rare. And so, the teams are flowing around the world all the time now. And so the difference between the team that does it well for us, because we want, again, our criterion is we want the core management team to locate here in Silicon Valley if they're not here already. So for us, what we want is a team that comes in and does not appear to be local anywhere. We don't want them coming in and saying, how, we've done all this work in Melbourne and we've done, we got these 3 customers down the street and, it feels like it's an Australian company. We want a team that has a global vision day one, and so that when they plant themselves in Silicon Valley, it's no different than if they were planted in Melbourne or Moscow or Paris. So you want, if you're pitching to investors here and you want capital here, you want to seem to be here. And you can seem to be, it's easy to seem to be here. You don't want to lie. You don't want to say you're not here. But you want to seem to be here and of this ecosystem and capable of operating here. We don't want to have to think about, can we transplant you? Will you fit in? All that sort of stuff. But that's us.
So a couple of other comments. I would say that, of course, the first thing is especially for people not mastering the English very well, it should not be a mental barrier. I know sometimes some entrepreneurs feel at a disadvantage because their English is a bit broken. Look, I'm a VC and my English is broken too, so that's the first aspect. The second is, I think what you need to realize, especially if you come with a foreign business plan, is to set up the context. Because if you come and pitch a story here, by definition, because we're in Silicon Valley, our intellectual process will put it in the kind of a Silicon Valley context. Sometimes you could have a great business plan and make a lot of sense in another region. So here I would advise to give a bit more element to paint the context of where you're operating and why it makes sense. Because that's a gap we cannot do very easily because we don't know your market or your area. That's the extra mile I would do. And I see myself too many entrepreneurs that want to look and smell Silicon Valley-ish, which I think is a bit of a waste of time. You should be yourself, but not doing enough effort to create the context of your picture or the vision of your business in your specific geography and region, even if you can be global. I would say in a nutshell, be yourself. We'll adapt, basically.
I think from our point of view, we certainly are looking for global partners, and maybe with a slightly different twist, because we operate in so many geographies outside of the U.S., we're specifically looking for partners who are strong in those geographies, especially in the BRICS or the other fast growth emerging areas. And so it's actually to an advantage if you can come in and show us that you're strong, or you've got some beta customers, or you've got some share in a market that's in one of the areas that we're trying to establish leadership or growth in. So I think, you know, if you can show that you're strong in an emerging market, then that's certainly an advantage that we'd be looking for.
They said it all? Yeah, pretty much, right. By the way, do you have any questions?
I just want to have an interesting argument. It seems that very often you talk to companies that are not present here in Silicon Valley, and they're going out of their way to be present here. What would you recommend to startups that are coming out of Russia or Brazil when they come here and they, and they hear things like that? Thank you.
Let me try to it sounds to me that you have a model in mind, which is the kind of internet or business model where you could be a very successful franchise in Brazil and or Russia or whatever, and you come here. And I think at least China and to some extent Japan in mobile, and recently Russia with Yandex has demonstrated you could be extremely successful as a franchise just tapping your region. So you could be in some cases, why do you want to come here? That you want to come here to have some business development of intelligence, so you can be, you understand the business model and you're the first one to put them in place in Russia. Yes, I buy it. But why would you come here in some case? So the second element I would try to put is, of course, now if you have an imperative reason to come here because of the market, you want to sell to US for plenty of reason, then I think you have to be able to articulate why you'll be competitive. So I don't think there is a kind of a ranking order or pecking order necessarily determined, because me, frankly, I told several European companies, but why do you want to raise money in US? Why do you want to come here? Why do you want to have on your board a VC that may not understand exactly what you're doing in Italy or Germany or Israel? Get somebody to understand it, you know? So you should really ask yourself this question, why you want to come here? If there's not a compelling business reason, you should not. It's a waste of time. You're going to get somebody of your board for 5-6 years that will be pain in the ass. Get the money from somewhere else, I say.
Okay, so I guess we're taking it a notch up. Let's
Yeah.
keep going, right? So what else do we want to tell?
Well, I would add one bit to that. I rarely see companies that have that tack work very well anyway. The companies that come from other geographies to Silicon Valley tend to be thinking about a global presence from day one. And that's the way most companies, most people think, unless you're just targeting the China market, which is huge in and of itself, right, or India. But other than that, I think you're targeting US or one of those two, or you're thinking globally from day one, not from Russia here or from Vietnam here. That just doesn't work very well. I see it a lot from Korea or Japan to try to come into our market. It doesn't work very well. You're thinking globally from day one if you're an entrepreneur like that.
So, yeah, I absolutely agree. I mean, the presumption is you you're here for a reason that makes sense rather than just hoping you might raise money. And the reason that makes sense is this is a natural market opportunity for you from which to expand. Tactically, the answer to your question, you get off the plane from Moscow and you want to raise venture capital, you should do a few other things first, right? If you walk in to the VC and you've just gotten off the plane, you're going to feel as though you just got off the plane, and that's not going to work. So what you need to do, and the fact that you guys are here proves that you're doing it, right? You're doing the tactics.
And not the first time. There are people coming back over years.
Right. So you plug into the ecosystem. So you get here, and first you plug into the ecosystem, and you get to know the names and the players and the lay of the land, and you can, it's important to be able to drop a bunch of names that are credible, I just, whatever, right? I was just over at Facebook, and we're doing a deal with them, and, whatever, right? Again, tell the truth. I'm not advocating lying here, guys, right? But tell the truth well. So what that means is plug into the ecosystem, get some connections, understand the lay of the land, get some conversations going. God bless if you can get some betas, if you can leverage whatever you've done overseas into actual activity, business activity, not fundraising activity, but business activity here, then you feel like you are part of this community and you don't feel as though you just got off the plane.
It's a very good point, yeah.
Let's say you, the company from a different region, you like them, and you consider investing. What's your requirements in terms of legal structure and the IP residency? Meaning IP residency, where, let's say they're coming from other parts of the world, right? Where you want the IP to be if you consider to invest in or co-investing?
Yeah, well, I think, from our point of view, it's a big issue because obviously if we're going to partner with you, we need to know whether you own your IP and whether or not it represents an asset that we feel comfortable partnering with. We're not going to invest in you directly, so it doesn't become an issue of that, but it does become an issue of that needs to be resolved right away so that we understand what it is that you are representing. And if we are to join forces and we are to bring your product to our customers, we need to know what we're selling them. And so I think it just becomes a question of clearing the air around it, getting a good understanding of what you have, and whether or not, frankly, you own it. That's the most important thing.
You guys want to add, Skip?
Yeah, for us, a lot of funds, it's structurally stated whether you can invest internationally or in international entities or not. We happen to have one that we can easily do it. I think we would greatly prefer, and the hurdle rate is a lot lower if it's structured as a Delaware, California C Corp. Makes the most sense. We have invested in other geographies as well. It's just more cumbersome legally. You need to have representation there. There's just, the boards are structured differently. The way everything's distributed is different. It's just more cumbersome. So I think the hurdle rate's much higher if you're a foreign entity, at least for us. And dealing with Cayman, Chinese entities is a pain. And then IP, that's a big, it depends. Where are you selling? Who's, in general, we'd probably like to have the IP here, but not always. It depends.
Yeah, Eric?
No, I would say another point to add is really to find a structure where the IP can be defended and protected. So if you go to Russia, nobody is going to put money in a Russian company. So you have to create this offshore operation with Cyprus or Luxembourg, is making more and more in fashion, which are well understood mechanisms, by the way. So I think it was the same, and it's still the same problem in China. It was the same problem in India. It has been fixed. So these are really, really tough legal issues that I think there is no compromise on this one, okay? After dealing with different corporate laws in different geographies, different funds will have a different flexibility. Things which are we don't like is that sometimes you have certain countries that want a majority of the board to be from the country. That could create a big problem when you want to create a global board. But IP is a real issue. Put the IP in a place where it can be challenged and defended. I don't think any VC will move if this is not done.
I
continue, my question is to everybody. What, at your point, is more important for startup? First, the great idea, or either the great idea or the great team?
Can I say in a provocative way, the most important is the timing. Because when you see very successful company, they hit the perfect timing between the market demand, their product readiness, and the team gelling together. So my answer is none on what you say. Hit the market at the right time with the right product and the right management team. That's a make or break of a lot of good companies.
My view is, I'm going to change the question slightly too. It's both of those, but it's also a great company. Because I think, and Sasha knows this, as we look at a lot of great entrepreneurs in the audience and in Russia, and we look at a lot of great ideas, and even some teams, what we're missing still is the concept of a great company. And for IBM at least, we need to partner with a company, because that's the structure in which we're going to work. And I think that is the area that needs the most improvement as I look out at venture capital in Russia, is this notion that you need to form solid, scalable companies around great teams. Then we have a basis for partnership and a basis for helping bring you to market and so forth. But just an entrepreneur, just a few people around a great idea doesn't equal an entity that we can really establish a great partnership with.
I'll answer you directly. A great idea with a mediocre team means it's not going to work. A mediocre idea with a great team, you still have a chance. Yeah. And I think we've all seen in our 10 or 20 years of venture capital experience, team problems that drive a company into the ground. It could be fighting, it could be a founder who doesn't want to release control, it could be a gazillion things. But we've also seen very good adaptable teams that are nimble and can pivot and go a different direction and read the market that can create something of value. I think Bill said earlier that often you don't continue down the same path. You might take a different direction, and almost every company does. Sorry, Eric, if that was yours, I can't remember.
Yeah, that's true.
But good management teams can do that and navigate difficult situations and make something of it. So I absolutely 100% think it's a team over an idea.
Yeah, I happen to agree with that. It's always a team.
Yeah. Yes, so the challenge is, it's, as you sort of heard from this group, it's kind of a false question. That that's really not the whole story, and it's not the basis on which anybody makes a decision. Team is important, as idea is important. I'll push back a little on my comrade Skip here, in that I think a mediocre idea, period, is a mediocre idea. So why would you invest, right? So why are you spending your time with a mediocre idea if you're such a great team? So from our point of view, we're not interested in a great team with a mediocre idea. We're interested in a great team with a great idea, right? But that's, again, that's the false question aspect of it. What I think was mentioned here is ultimately at the end of the day, I don't think we've actually, rarely have we heard a unique idea in our conference room or submitted. So there's so many entrepreneurs, just off the top, if you haven't yet talked to investors, so many entrepreneurs think they've come up with a unique idea. And they approach investors thinking they've come up with a unique idea. And I can't tell you what a turnoff it is for investors to get some entrepreneur coming after them saying, I've thought of something that nobody else on the planet has thought of. Can I get a meeting with you? And and you say, well, okay, what's the idea? And they say, well, will you sign an NDA? Because it's such a brilliant idea, right?
Actually, that was my other question, and I'm glad you brought it up, because a lot of time in Russia, you pitch you and they want you to sign an NDA, and we always say, no, we never sign NDAs. Will you stay on that and comment a little? Why not?
Yeah. So, well, and so we never sign NDAs up front. We will further way down deep just before we invest, right? But you never sign NDAs up front because, again, our experience is we've always heard the idea before, or some flavor of the idea before. And so the unique twist is that within a brilliant idea, there are brilliant ideas out there, But within a brilliant idea, you have some extraordinary unfair advantage as to why you can exploit that and you can win that nobody else has for some reason. Maybe it's technology, maybe it's team and background, maybe your guys are the 3 guys on the planet who have ever accomplished this, technology before. That could be exciting, right? But, so it doesn't make sense to sign an NDA, and it doesn't make sense to believe that your idea is your competitive advantage. Because, if all you have as a competitive advantage is your idea, then how are you ever going to win in the marketplace? Because as soon as you, announce, then your advantage is gone. So it's not about the idea. It's about the ability of the team to uniquely convert that idea into a successful company.
And execute. Yeah, that's important too. The mic is there. Please introduce yourself.
Hi, my name is Eugene Mazzo. I'm co-founder of DigiLogic. And my question is really around valuation. There's obviously a lot of different methods and a lot of different variables in play when evaluating a company. My question really is, for you guys personally, are you looking more at the value of the company as it is today, or do you look at potential value, and where is that balance?
I think we're far more, we look into the future value and work our way back to come up with a valuation that works for the current round. So we will run the numbers, extrapolate what we think the ultimate terminal value of the company will be, and then work our way back to make sure we're paying a fair price to get the return that we're looking for at that stage of the company. So we will run the whole analysis. At the end of the day, that's a justification for the value that we're paying, because it comes down to a negotiation between founding team and venture capitalist, taking into account whether it's a competitive market or not. If it's a competitive market, then the competition drives it. Or if Yuri Milner's involved, then it's just way up here. So it's a completely different stratosphere. But anyway, that's the way we do it.
Bill?
It's, well, I'll share. We actually have an algorithm that we use for the valuation. And this is, I'll give credit to my partner, Guy Kawasaki. Our algorithm for valuing a company is you're worth $250,000 for each engineer, minus $500,000 for each MBA. So that's that's our algorithm. But seriously, I mean, I Skip articulated the same way we do it. Basically, our metric is we want to see a 20x return on our first check-in. So we're sitting there around the deal and trying to figure out how much money is going to be required, how many rounds of finance, how big we think this can grow, how much we're going to discount the spreadsheet that the entrepreneur gave us in terms of their hockey stick growth. And as Skip is saying, and I think a lot of VCs look at it this way, basically we want to make sure that we can get to this potential for having a huge outcome based upon all of the dynamics around the company and the funding requirements and where the company is today, and then negotiate something fair.
Yeah, Eric.
I think it's about the same for us. We're making sure that post-financing, you have a post-money, that you can refinance the company at a step up. Some of you must have been in some down round. It's not fun. The founder felt are feeling they have lost. The VC2, the options are underwater. So for us, that's really what we are looking at. Can you refinance as a step up? The second element where I think very often there's a disconnect between the investor and the entrepreneur is not so much on the math and the algorithm, but it's at the end of the day, how much money you're going to need to be profitable or whatever is the milestone. That's very often the delta, because by definition, the entrepreneur is more optimistic. By definition, we are more conservative. And sometimes it could be a factor of 1 or 2. So you have to put twice the amount of money. Of course, the valuation is not as nice. So that's our view. But avoid the down round is always a painful experience.
So the bottom line is there are a lot of elements to the formula, and the more experienced a venture capital fund is, and the more stuff they've seen in the history of investment, then that's what the formula becomes more complicated, but it's always going back from the future valuation.
when VCs meet with entrepreneurs, the usual story goes like this, that the VCs would usually explain startups the reasons why they would not invest in them, and those reasons would be usually associated with different shortages associated with those startups. Let me turn the table here in my question and ask you this question. What are the 3 top reasons why you would not invest in a startup that looks really attractive for you, but there might be something that would prevent you from investing in that startup? And by those reasons, I mean something that is related to your industry or maybe to your company, or something that basically prevents you from investing, even if you think that this startup is really, really, really good. Thank you.
Recently, and I think for us at least would be sometime the syndication. If we feel that for some reason the syndicate which is put together is the wrong one, it has happened to us recently. Only the future will let us know if it was a good or bad decision. That could be one reason where unfortunately the entrepreneur has a less influence, I would say, than on the business. The other reason could be that the amount of money raised will not give the startup enough time or the capability to develop a real milestone. Sometimes we could be cross-wire on a great company, great guys, but we feel that they are raising too little money and they're going to be stuck in the middle of the river. That would be 2 reasons for a good plan, good team in the focus. We pass, and we've done in the past. You know.
I'll give you one more, and I rarely get this question from entrepreneurs, but I think it's a very good question to ask, is where you are in your fund cycle. Because perhaps you're at the very end of your fund cycle and you really don't want to make that early stage seed investment that will take another 8 years to come to fruition. Or maybe you're really early in your cycle and you're willing to take that risk and you don't need to recycle, do a later stage investment. So I think how much dry powder you have left, kind of Eric's point, you want to make sure that you have enough money to be able to put in this company over the years. And if you're later in your fund cycle, you might not have that. Or you don't want to take a really early bet as one of the last investments in that fund. I think that's a very important question to ask.
Yeah, a couple of examples come to mind as you say that. Again, it's a kind of a rare question, but it's a good question. And one deal we fell in love with, it was 3 guys in a basement in Calgary, Canada, doing a photo sharing site, and they were just rocking. And we thought this is the coolest company, and we wanted to, give these guys money, but they were a Canadian company. I mean, their cap table, their organization, it was a mess. And we talked to the lawyers, and the lawyers were saying, oh my God, it costs so much, and there's a tax. I mean, so the reason we didn't invest was just the structure, the underlying structure of the company related to where the venture industry was at the time. And then 2 other examples. One was we discovered that the founder was a felon. That's kind of...
Oh, that's an easy one.
An easy one.
It was, nobody would have thought, but it turned out he was a felon. And then the other one was, and without particularly casting any particular sense of it, but it was an Israeli team, brilliant company, and the founder was just so stuck on the valuation number, which we thought was excessive. And we just couldn't get over the hurdle. So.
And just to add to it, a couple of companies we saw, it was a terrific technology and a good team, but the founder, it was clear, was not listening to anybody. And it was absolutely clear he didn't think highly of us as an investor, just needed the money. So the technology was brilliant, but we passed. Any more questions?
So the question is, for early seed funding, what are you looking for in terms of in what stage does the company need to be? The idea, the team, the product? Because for every VC, there is a different level of where the company is in terms of the development. So I'm just sort of interesting to hear what you guys have to say about that.
So I guess we're the earliest of the group, I guess, on the panel. So again, garage is all about 2 guys in a garage, or 2 gals in a garage, or a guy in a gallon, whatever. I mean, the point is, Yeah, so the point is that there's no such thing as too early for us in terms of when we could potentially fall in love with a company. The issue is that you're competing with other companies that are at various stages of development. And so for us, the difference between a startup with a great idea and a great PowerPoint and whatever, and a startup with a great idea, a great PowerPoint, and a beta product with 50 customers, right, or 50 users, it's kind of hard. So what we'll do, I'll tell you, the dirty little secret is we'll be your friend to see how things go for some period of time before we write the check to see if you are getting the traction that makes you competitive with the alternatives. So any given week, we don't have to make a specific investment. So most likely, again, the point is it's never too early for us to at least have the conversation, but consider, that we're not going to write the check until we see some indication that you've got some capability to execute.
They want to add, Skip, or?
For us, it just depends. I mean, it's always risk reward at this stage, and we have a seed program that we put in place a couple of years ago that's been pretty successful. But we're willing to take a bit more of a risk on perhaps an entrepreneur that we've worked with before, or one that checks out really well, or if we think, boy, this could be really big and it'll be very competitive in the Series A. If they hit their milestones, we need to get in now because it'll be so competitive, we'll pay a higher price, we may do that. I think those are kind of the two things, but it's basically risk reward. And we're willing to take some risk if the price is lower, it's earlier stage, but we still have to have the basic fundamentals of team, market, technology, et cetera, in place.
I'll just add, from an IBM point of view, our sweet spot is kind of around a late seed A round kind of place, because we're looking to build a partnership with you. We'd like you to have some customers that we can kind of use as references. When we're trying to sell this to our sales team, for example, they're going to ask, okay, we're willing to take a chance on bringing this startup in, but who have they worked with in our industry? Who are your references? What customers have you worked with that kind of show that your technology works and scales? So I think we're probably a little bit later in the process than Garage, for example, but not too late, because we think we can give you the most value when you are young and you're still making a lot of decisions and can help you. So we're kind of still in the early stage piece, but not too early.
We have time for one more question. Fine. Okay.
If you could just say, how difficult is it for you to raise money from limited partners? And there were stories like 2 years ago that 30% of all VC funds are going out of business. Is it still something that the VC industry is facing right now?
I don't think the 30% number is exaggerated at all. No, I think it's probably even higher as far as number of firms, number of dollars, and number of general partners or people. It's at least 30%, maybe more. And because the industry moves at a very slow pace, because we have 10-year funds, it's still a work in progress. And it's a difficult fundraising environment still, the hangover from 2008, where limited partners don't have a lot of capital. They're still leery of venture capital returns because they haven't been that stellar. But it's starting to come back. We're seeing some movement in the right direction, but it's been a pretty tough 2 or 3 years for venture capital. And one other comment, which I think is very fascinating, to hog the microphone for another minute, but just the bifurcation of the venture capital world, where you end up with the very large funds, the ones that have been around for a very long time, that are it's Greylock, it's Kleiner Perkins, Sequoia, and they become very vertically integrated. They have seed programs, but they're also doing investments in Facebook at a $65 billion valuation. Is that venture capital? I don't think so. There are some firms very guilty of that. And then on the other end of the spectrum, you have the super angel phenomenon, or just the single angel phenomenon of someone who made a little bit of money by selling their company to Zynga or Groupon or whatever, and they've got a few $1 million and they're spraying it around. So there's a very, very active environment at the seed level, and maybe even the Series A level, and a very active environment at the late stage. But what I would be worried about if I were an entrepreneur is what happens after you take that seed capital, who's going to be there for the Series B, because there aren't that many players out there. It's a very, very sparse environment.
So if you're I mean, the relevance to you as an entrepreneur is a function of where you are in the ecosystem. There's some parts of the ecosystem that are relatively robust now, the social, local, mobile gaming, domain, where, as Skip is saying, there's a lot of angel, super angel, small fund money that's popping into that domain. But there's a huge question in terms of if you don't have an extremely capital efficient model, there's a huge financing risk question. And there's also this huge competitive, question for you, is you're going to be competing against 30 other venture-backed companies if you have a sort of clone type of social local mobile gaming company. So it's, if you're in that space, you want to try to find a syndicate of investors that can carry you all the way through and make sure you're differentiated. If you're in big data, that's bigger kinds of VC money, and that's relatively robust now, and that's where some of the legacy guys are focusing their early stage stuff. But a lot of other sectors, enterprise software now, unless it's in the social local mobile, is a tough space. So it depends on where you are in the venture ecosystem as to whether or not you're going to be impacted by what is clearly dramatically going on in the venture world right now.
And this is a rare breed, early stage funds. Yeah. Because now the big ones, Skip, to your point, they've been around and they'll stay because they can invest in all stages. But if you specialize in early stage, I think that was the hardest segment to go through the changes.
The question is, are there lessons learned from the companies you did not invest in? And do you look at companies differently now?
Unfortunately, what's coming back to mind is the iStock photo question. Companies that were just, tantalizing beyond reach, and we decided there's always another fish in the pond. We're not going to, do an unnatural act to invest in the company. But it probably was still the right. I mean, generally, it was the right thing to do as an investor. The iStock photo issue was that the cap table was messed up because it was Canadian and all that sort of thing. So that's my lesson learned.
We didn't invest in Evernote, for example, and looked at them many times, and their cap table was really, really messed up. So to your point, and look at them, they're doing great. Skip, look at it too. I think we're done because we don't want to. You've been a wonderful audience. Thank you very much.
Thank you.